Hi, everybody. Welcome to our webinar today. I'm Leslie with the New Mexico Small Business Development Center. I want to introduce Ian Alden. He is an attorney here in New Mexico, and this is going to be a lot of information, and I think it's going to be so important for everyone. Today, our topic is LLCs, DBAs, corporations, and S-Corps. I'm assuming we're going to figure out what the difference is between the four different entities. And so we're going to get started in just a minute. I do want to let everyone know to please type your questions into the Q&A. We will pick those up and leave plenty of time for answering the questions. So if everyone's ready, without further ado, Ian Alden.
Hello, everyone. My name is Ian Alden. I'm happy to be giving this presentation today. A few COVID-19 related resources you might want to be aware of are on this slide here. Hang on one second. A few COVID-19 related resources from the state, the federal government, some guidance on how to operate your workplace in a COVID-safe manner, important to know. So check out some of these resources. You should already have your microphones muted, but on the off chance that they get turned on for whatever reason, be sure to keep yours off. Make sure to set your Zoom ratio to fit window. That way you see everything on these slides. I'm going to be using the Q&A function here to take questions, but I would encourage you to hold your questions to the end. And the reason for that is simply because there's a good chance that whatever question you have come up, I'll answer in the very next section. So be sure to write down the questions that you might have in the slide numbers that those questions relate to, and ask them in the Q&A towards the end of the presentation, and I will answer as many as I can. I assume all of them. So today, that slide's out of date. Just ignore that one. We've got a few other counseling opportunities and assistance and training offerings coming up in the next few days. We've got this coming Monday, Trademarks 101. It's a workshop given by Larry Donahue, another attorney, all about trademarks and how you can use them for your business. We've got some other training coming up on the 30th and throughout the week, so be sure to check all of that out. So the presentation I'm going to be giving, there's three sections to it. Really, I'm going to be talking about different types of business entities that you might use and how they, sorry, hang on one second. I get a question right off the bat. How do you know the slide number? If you look at the bottom right, you can see this is slide 6, for example. So the slide number is in the bottom right of each slide. So we're going to be talking about corporations, partnerships, and limited liability companies, and kind of the differences between each of them, some of the benefits, the disadvantages, and how you can use them effectively in your own business structure. Because at the end of the day, everyone's business needs are different, and you want to make sure that you're taking advantage of the opportunities that these structures provide to make a structure that really works for you. But to start, we're going to go with traditional corporations. Now, corporations, when you think corporation, you might think, oh, large multinational business enterprise, a big international bank, for example. It's true that those are corporations. Most of those larger multi-state or multinational entities end up as corporations, though not all of them start that way. But many smaller business ventures also use corporations for their business structures. And so it's worth knowing what they are and how you can make them work for you. The first is profit corporations. They're your traditional corporation when you think of a for-profit business entity. They're governed by our Corporations Act here in New Mexico. Every state has their own separate act or legal structure that governs how corporations are made. It's all ultimately based on state law, at least at the start when you're forming it. You make a corporation by filing articles of incorporation with the state. Your corporation is legally governed by the Corporations Act and your corporation's bylaws. Bylaws, it's your internal governing document, the document that you'd use to, describe how voting is going to work, how the board of directors is structured, how uh, dividends are going to be distributed out to shareholders, things like that. So the bylaws are kind of where you put all the meat and bones of how the corporation is going to work. A corporation, there's three different levels of governance of a corporation. You've got shareholders, which are your owners. You own shares of a corporation. That means you own a piece, like a respective piece of a corporation. You've got directors. Directors are kind of the upper management for the corporation. They are appointed by the shareholders. They make high-level corporate strategy saying, we want to expand into this market, we want to do this or that. And they hire or fire officers. Officers are kind of the lower level managers of the corporation who run the day-to-day operations. So they serve at the pleasure of the board of directors usually. They might have some kind of contract saying I'm going to serve for this term, but ultimately it's the board of directors that hires and fires officers. Officers, you might think of a CEO as an example of an officer hired by the board of directors or fired by the board of directors. There can be overlap with these. You see this frequently in smaller corporations, especially in New Mexico. I frequently form corporations for only one owner. And so there's one shareholder who's also the only director and is the only officer serving as president, secretary, treasurer, etc. These don't all have to be different people. So that's profit corporations. The next type of corporation that I frequently am asked to form is a nonprofit corporation. Think of these as the bedrock foundation of a 501c3. You hear people talking about their 501c3 organization. That's really two parts, which I'll cover in just a little bit. But the first part of that is the state level nonprofit corporation that you form with the state before you ever reach out to the IRS about nonprofit recognition. It's governed by our Nonprofit Corporation Act. Same deal. It has an articles of incorporation and bylaws. The bylaws look a bit different, obviously, because unlike with a profit corporation, there's no shareholders or owners of a nonprofit corporation. There's directors that carry out the nonprofit mission or purpose, but those directors aren't acting at the behest of shareholders. They're acting for the good of the nonprofit and its mission or purpose. So the idea with a nonprofit is it's self-sustaining, with the board of directors, getting elected, swapping out directors based on the company's bylaws and in compliance with the act and the IRS mandates for how that all works. But there's no owners. Now, before you can apply to the IRS for nonprofit recognition under IRC, 501c3 or 501c4 or any of the other nonprofit sections, you've got to make the state level entity. Once that entity is made, then you apply for federal recognition, which you need before you can start soliciting or accepting nonprofit donations. The idea being that until the IRS recognizes the company as a nonprofit, it's taxed like a C corporation. So you need to make sure once you form the state level entity, you apply for federal recognition, and you have to do it in that order. Nonprofits, there's of course limitations because there's no shareholders, there's no profit motive. So directors, officers, and employees can't engage in self-dealing or personal enrichment at the expense of the nonprofit. The idea being that everyone is there to contribute to the nonprofit's mission. You might get paid a reasonable salary as a director or an officer or an employee. Reasonable is determined by the IRS, but you can't just use the nonprofit as a profit vehicle. When you dissolve a nonprofit, it's got to pay out anything that it has in terms of assets to another recognized nonprofit. That's an IRS mandate for you to get 501c3 recognition, for example. The third type of corporation is another one that we see commonly. It's a professional corporation. They're used for certain categories of licensed professionals, doctors, lawyers, dentists, etc. Um, Therapists, I also see some professional corporations for. It's functionally the same as a profit corporation, except that all of the shareholders need to be licensed to provide the professional services the corporation is organized for. So, you can't have, for example, non-doctor or non-lawyer owners of a professional corporation that's meant to provide those services. Every owner has to be licensed. If they stop being licensed, they can't continue to be owners and they have to sell or forfeit or surrender their shares. Professional corporations, they used to be more the norm in the states and in other states for doctors and lawyers and whatnot, because the licensing boards would require that they use professional corporations to make sure that the business was only owned by licensed professionals. It was a way for the licensing boards to maintain control over the practices as businesses. They've kind of fallen out of favor somewhat with the advent of LLCs, which we'll talk about later. Most licensing boards, at least in this state, let you use an LLC in lieu of a professional corporation. For example, one of my law firms is organized as an LLC and another is organized as a professional corporation, and both are acceptable. Like profit corporations and professional corporations can elect to be taxed as one of two kinds of corporations, which I'm sure you've heard some about, and we're going to cover in more detail here. There's S-Corps and there's C-Corps. S-Corps and C-Corps, they're two very different styles of corporate taxation and governance. Which we're going to cover now, but you can elect that sort of taxation for both profit corps and professional corps. So we're going to start with C corporations. When you think of a C corp, most people think, again, large multinational institutions. And it's true that those are the entities that typically elect to be C corporations, but in all actuality, most publicly listed companies, that's companies that have their shares publicly traded with a stock exchange, for example, elect to be C corporations. And I'm going to cover why in the next few slides, but most larger corporations end up being C corporations as opposed to S corps. They're double tax entities, which means that unlike pass-through entities, which we'll again cover in a little bit, C corps are subject to what's called corporate income tax. And that means that when a C corp has net business income, that's, profit or, gross income less deductions that can reduce the taxability. The net business income is taxed to the corporation at the corporate income tax rate, which is currently 21% federal, and then, if I'm remembering right, somewhere in the ballpark of 5% state. It varies a lot by state, but some states have corporate income tax, some don't, but the corporation pays that tax. And then once that tax is paid by the corporation, the money sits there in the corporate bank account as what's called retained earnings until either the corporation reinvests that, maybe by buying new equipment or doing something else with it, or if the corporation issues dividends up to the owners. A dividend is really just a payment to a corporation's shareholders from the corporation out of retained earnings or profits. So you hear there's a lot of companies out there that are what's called dividend issuing companies, because not every company issues dividends, but the companies that do, they're dividend issuing companies, and they are a huge part of the investment holdings of, for example, retirement accounts or portfolios, because they pay out a percentage of their profits to their owners. So they're a great way to hold an investment in a company that maybe it grows, maybe it doesn't, but it's going to provide you a steady income stream. But that's what a dividend is. When a corporation issues dividends up to the shareholders pay tax again on that money at the dividend rate, which is up to 20% federally and whatever state. That's why it's called double taxation, is because if you look at the money that goes into a C corporation, it gets taxed once to the corporation, and then it gets taxed again to the owner when the owner takes out a dividend. This used to be a huge thing. I mean, a huge burden when our corporate income tax rate was 35%. Now it's 21% because of the tax reform law Congress passed a few years ago. At 21%, the C Corps are no longer considered tax disadvantaged by default. In fact, as compared to pass-through entities, which again we'll cover, but the gist of a pass-through entity is it's, the profits and losses are taxed directly to the owners at their personal income tax rates, which can be up to 35, 37% federally plus whatever state. 21% is not that bad on its own. So if you get a corporation that wants to get its profits and then reinvest those profits, maybe in new business locations or equipment or whatever, C Corps can actually be advantageous for that purpose, because whereas you'd be paying tax at maybe 35, 38% with a pass-through entity, you're initially only paying the tax at 21% with the C Corp. So C Corps have turned into pretty useful business entities for growth purposes. And so it's really important to kind of look at your situation when asking, should I have a C Corp or not, and see, what your growth strategy is going to look like, because it's no longer worth dismissing a C Corp out of hand. C Corps are the preferred vehicle of investors, especially institutional investors like venture capitalists, for example, because you can have multiple classes of stock. Class A, Class B, common, preferred, etc. And different classes of stock create different rights for the shareholders for voting, dividends, liquidation, payouts. I mean, you can really customize these classes of stock, which is great for institutional investors, because, let's say they want to invest in a company, but if the company is risky and it might go under, those investors want to get paid out first from any liquidation proceeds to try and recover their investment. Preferred shares or Class B shares let you do that. And so C Corps are great for those investors. They're also useful for investors who don't want pass-through taxation of their income, because pass-through taxation, when a pass-through company receives net business income, it's automatically taxed to its owners at the owner's personal tax rates, regardless of whether the owners actually get that money distributed to them. So that might work fine for small business owners. Institutional investors don't want to deal with the bookkeeping and the financial impact of pass-through taxation, especially if they're not getting that money paid out to them. So yeah, C Corps are really common for companies that are going to solicit investors or go public. The other type of corporation is an S-Corp. S-Corps are often referred to as small business corporations, even though that's not really what the S stands for. It's one of several pass-through entities, which we're going to talk a little more about. No double taxation. S-Corps are not subject to corporate income tax. So when an S-Corp receives net business income, again, that's just it's taxable income, it's income less deductible expenses. That net business income passes through to the shareholders for tax purposes and is taxable to the shareholders at their personal, federal, and state income tax rates. And so what that means is, your company has $100,000 of net business income, and it's got two 50-50 shareholders. Each shareholder is going to be personally responsible for 50% of the taxes on that company's income, on that $100,000 of income. The income passes through for tax purposes, even if the shareholders don't get that money distributed to them. This is why a lot of companies that are pass-through entities have mandatory provisions in their bylaws or operating agreements saying the company will, every March or April or whenever, distribute an amount to the owners sufficient to cover their tax debt. That's what's called a tax distribution. It's pass-through taxation works for a lot of people, but it can get pretty messy. S-Corps, they've got a lot of restrictions imposed on them. You can only have up to 100 owners, which is one of the reasons why it's considered small business oriented. Cannot have any non-resident alien owners. That's a term used by the Internal Revenue Code. It's not one that I invented or personally like, but that is the way they describe people who are neither citizens nor legal permanent residents of the United States. So you can't have any non-resident alien owners of an S corporation. And you can only have one class of stock. That is the kicker for a lot of people because it has ripple effects on how the company can really operate. One class of stock means that you can only allocate and distribute profits and losses on a pro rata basis based on everyone's relative percentage of shares owned. So if someone owns 40% of the shares of an S corporation, they must be allocated 40% of the profits and losses. There's no way around that. Similarly, they must have 40% of the voting rights within the corporation. Because disparate treatment of different shareholders can create the inference that there's more than one class of stock, which blows the S-Corp election. And if a corporation is by default a C corporation. You can elect to be taxed as an S corporation, but if a corporation violates the S-Corp rules, it reverts back to a C corporation. So you have to be careful that you're not doing things that could give rise to that kind of revocation of the S-Corp election. For these reasons, they're not ideal investment vehicles. It's hard to get people to invest in an S-Corp. But you can always make an S-Corp and convert it to a C-Corp later. It's always a little tricky for tax purposes when you do conversions back and forth, but it's doable. S-Corp shareholders, this is an interesting one, must be paid a reasonable salary by the corporation. Reasonable is determined by the IRS. It's W-2 income to the shareholders who receive it. The salary is deductible by the corporation as was called an ordinary and necessary business expense. So it's not like the shareholders are paying tax on the money that's being turned into salary for the S-Corp shareholders. That would be a form of double taxation. So that doesn't happen here. The salary paid out is deductible by the corporation, so it's not double taxed. It's subject to your typical payroll deductions, income tax, FICA, Social Security, Medicare, et cetera. And that's why the salary exists in the first place because, and this is the big reason a lot of people use S corporations or have their LLCs taxed as S corps, which we'll talk about later. Most pass-through entities, the owners are going to pay a few different taxes on the money they receive. They're going to pay income tax, federal and state, and they're going to pay what's called self-employment tax, which is the employers and employees portion of Social Security and Medicare taxes. Self-employment tax is 15.3% of net business income. So S corps with the salary, the owners pay their salary, you pay Social Security and Medicare out of the paychecks. The company pays its half of Social Security and Medicare on top of the salary, but then any net business income above and beyond those salaries is not subject to Social Security and Medicare taxes. That can be a huge tax savings to S-Corp owners. It's 15.3% up to the Social Security cap for each shareholder, and then 2.5% for Medicare beyond that. So that's why a lot of people use S corporations over any other type of structure, is for that specific tax savings. So that's corporations in a nutshell. Again, I'm going to cover partnerships and LLCs in the next few minutes, and then we'll circle back and take questions about everything, because what you're going to see here is that there's a lot of mixing and matching and choosing and dovetailing with everything. But that's corporations, and it's important to understand them because even if you're not going to use a corporation, you might end up using an LLC, which can be taxed as a corporation and is subject to a lot of the same restrictions. Now, partnerships have been around for practically forever in the eyes of the law. I mean, they're the oldest form of business structure. Partnership is just the association of two or more people to carry on as co-owners a business for profit. That's at the heart of what a partnership is. Two or more people carrying on a profit venture as co-owners. you can form a partnership whether or not you intend to. And this has gotten a lot of people in a lot of legal trouble for reasons we'll cover in a second. But partnerships, they're not formal structures. You don't form a partnership and register them with the state, at least not in the state of New Mexico or in most other states. You can make a partnership and it exists on paper, it could exist verbally, but it doesn't need to exist in the eyes of the state. You don't need to register it with the Secretary of State like you do corporations or LLCs, which is why it's very possible to create a partnership inadvertently. The mere association for profit can create a partnership if the parties are non-specific as to what their form of their arrangement is. What that means is, let's say I get together with someone and I have this great idea and I say, I want you to help me make this a reality. We need to make this new app, get it off the ground, launch it, and start getting mad profits from it. If I'm that non-specific, it's very easy to infer from that, especially if I'm the other guy, that what I'm intending is a partnership where we're both going to work on this thing and we're both going to derive profits from it. I may have inadvertently just created a partnership. That's why most written contracts between people or businesses for services or employment very specifically provide that a partnership is not intended and is not being created. Partnerships are another form of pass-through entities. Profits and losses pass through to the partners, and the profits are taxed to the partners at their personal income tax rates. Partnerships file a Form 1065 partnership income tax return each year and issue K-1s to the partners. So if you've ever heard of K-1 income, partnerships and S-Corps issue K-1s to their owners. S-Corps have a slightly different IRS form. It's 1120S, but they both issue K-1s to their owners, reporting the profits and losses that are being allocated to each owner. So if you ever hear about K-1 income, it comes from a partnership or an S-Corp. Partnerships also have New Mexico reporting obligations, which also so do S-Corps, now that I think about it. But you've got to do information returns for the state listing the income derived from New Mexico sources, the income allocated to each partner, the partners who live in New Mexico, et cetera. So partnerships can carry a lot of reporting obligations. But the big kicker for partnerships and LLCs taxes them that makes people go towards S-Corp sometimes. Partners cannot be W-2 employees of the partnership. And what that ultimately means is that all of the money that partners receive from their company, minus specific guaranteed payments, is income that's subject to taxation, federal income tax, Social Security and Medicare and state income tax. So that self-employment tax I talked about, partners have to pay that tax on all of their money, which again is 15.3% of all partnership net business income up to the Social Security cap for each partner, which is like $115,000-ish per year, and then Medicare at 2.5% roundabouts for all the money on top of it. So S-Corps can give you more of a tax advantage than partnerships. Partnerships, though, are very easy to manage, comparatively speaking. And I'll just cover that here in this slide. Partnerships, you can really customize who's going to get allocated profits and losses, as long as it has what's called economic substance. So you can be a 40% partner, but get 60% of the profits and losses if you're doing more work, or 70%. It can't be an outrageous sum. You can't be a 1% partner, but get 100% of the profits. You can't be 1% partner and get 50% of the profits. It has to have economic substance, which really just means based in reality. But you can really customize partnership agreements in that way, whereas you can't with S-Corps. That's why a lot of people still use partnerships or LLCs taxed as them. Regular partnerships, there's a lot of disadvantages, which is why they've largely fallen out of favor given the creation of LLCs in the 1970s. Partners are by and large directly and personally liable for for the liabilities of the partnership. Debts of the partnership, judgments against it, etc. If the partnership takes out a loan, all the partners are directly liable for that loan. And it's not just that they're directly liable, it's that they're typically jointly and severally liable, which means, let's say you are a 1/3 partner in a venture with two other people, and those two other people are practically broke. I mean, you're the capital partner, you're the one who's putting in the money to make the venture work. And the partnership takes out a loan for $200,000, and the partnership folds and defaults on the loan. You, even being a 1/3 partner, might be on the hook to pay the entire $200,000 balance if the creditor can't get anything from the other two partners, because joint and several liability means that everyone who's liable is liable for the whole until the whole debt is paid off. So with that in mind, partnerships largely fallen out of favor because you can have an LLC that can be treated as a partnership for tax purposes. And we're going to talk about that in a little bit, but the LLC offers limited liability protections for the owners. So if the LLC takes out a loan and the LLC folds, assuming there's no grounds to pierce the corporate veil because the owners did something shady with the LLC, the debts of the LLC die with the LLC, and the owners do not have to personally pay for them. You might be out the extent of whatever you invested in the LLC, but you wouldn't be called on to pay off the rest of the LLC's debt. And that's important. That said, there are still some uses for partnerships. There's simple and flexible vehicles. Like I said, you can customize them. You don't have to do everything on a pro rata basis. You can make them for a limited duration, which you typically don't do for corporations. You have a partnership that, for example, I've got clients who are making partnerships right now to provide COVID-19 testing and vaccination services. And those partnerships are going to automatically terminate when COVID-19 is no longer a pandemic, unless it becomes endemic, in which case other things happen. But yet they're useful when you have just a joint venture for a limited purpose that you need to end at a certain point. And they're also really useful for business to business joint ventures, where let's say you've got two LLCs that do different things and they want to team up to do one thing. An example again is COVID-19 testing. I've got clients who are teaming up with one another because they, one has a building, one has employees who are licensed medical professionals, and they're teaming up to do COVID-19 testing. You have two LLCs. Each of these businesses has its own LLC already. So the owners of those LLCs have limited liability for the debts of the LLCs. So these two businesses make a partnership between themselves so that, they're doing this thing together. And then once it's over, it's over. Really easy to terminate and wrap up a partnership. And that's it. That's all she wrote. So you can still use partnerships for that purpose. And indeed, it frequently do. Now, there's a few different types of partnerships that you may have heard of. General partnerships are the base level partnerships where everyone is there. There's just one kind of partners, general partners, and they're liable jointly and severally for the partnership debts. Everyone can participate in management in a general partnership. Then you have limited partnerships, which are also quite common, especially with investment partnerships. Limited partners are typically the silent partners. They're the people contributing capital or investments. Limited partners are only liable for their individual investment. If you put in $100,000 to the partnership and then the partnership folds, you're out that $100,000, but you're probably not going to be on the hook for the rest of the partnership's debts. General partners, a limited partnership has at least one general partner and at least one limited partner. General partners are still on the hook for everything the partnership owes after, everything is said and done. So limited partnerships, fine if you're a limited partner. If you're a general partner, you're probably going to use something like an LLC to hold your general partnership interest. That way you still have limited liability protections. Otherwise, if you're an individual as a general partner, it's the same issue as with general partnerships. You're going to be on the hook for everything that partnership owes. Limited liability partnerships are basically general partnerships. You only have one type of partner, but none of the partners bear liability for the liabilities of the partnership. They exist, but they're hard to form in New Mexico. There's a lot of hoops you have to jump through. I've never formed one because when I look at a limited liability partnership next to a limited liability company, LLCs win every time because they're much easier to form and they're much easier to administer and they're generally easier to terminate. So I've never used a limited liability partnership in my practice, but they do exist. And then the last kind, limited liability, limited partnerships. These don't exist in New Mexico, really. Um, we just kind of refer them back to limited partnerships here. But they're a form of limited partnership in which none of the partners have personal liability for the liabilities of the partnership, but you still have different classes of partners, general and limited. And that's because general partners typically are the managers and limited partners are hands-off or silent partners. So there's useful reasons to structure them that way. They really don't exist here, as far as I can tell. But that's partnerships in a nutshell. Um, the personal liability is a big reason why they're generally disfavored in lieu of LLCs, which we'll talk about now. Kind of feel like I'm saving the best for last because LLCs, they're fairly new to the scene. Wyoming was the first LLC state in 1977, and pretty much every state offers them now. The IRS has a great deal of disdain for LLCs. You can now check the box and have LLCs taxed as whatever you want. But in 1970s, 1980s, the IRS was really miffed about these things because they knew how to deal with corporations. They knew how to deal with partnerships. They didn't know how to deal with the state invented entity that could be taxed, at least in the eyes of the state, as whatever they wanted to be. So it's still a bit of a thorny relationship, but the IRS works with them. It is what it is because over 2/3 of all new companies formed now are LLCs. And there's a good reason for that. LLCs are highly customizable business entities. The LLC Act for each state, the Act in New Mexico, and the LLC's own operating agreement, which is an LLC's form of bylaws, basically. They govern everything: voting, decision making, handling of profits and losses, and you can really customize the operating agreement depending on how the LLC is taxed. Because you can have the LLC taxed as anything else. I mean, by default, an LLC with only one owner is taxed as a disregarded entity. By default, an LLC with multiple owners is taxed as a partnership. You cannot switch that around. You can't have an LLC with one owner taxed as a partnership, and you can't have an LLC with multiple owners taxed as a disregarded entity unless the LLC only has two owners and their spouses in a community property state. So New Mexico, two spouses, husband and wife, husband and husband, whatever, own an LLC together. In New Mexico, we're a community property state, so you can have that taxed as a disregarded entity or a partnership. It's your choice. But otherwise, you can have your LLC taxed as a corporation. Anyone, no matter how many owners the LLC has, can elect to have the LLC taxed as a C Corp or an S Corp. So when I say flexible, I really do mean flexible. A few points of interest: LLCs have members as opposed to shareholders. An LLC can, but doesn't need to have officers. Typically, an LLC will have a managing member, and that'll be their officer. I've seen some LLCs designate president, vice president, etc. It's not required. It's quite optional. LLCs have units, membership units, as opposed to shares. So, an LLC can issue units. An LLC taxed as a partnership or a C Corp can issue different kinds of units to its owners. Or an LLC can just use a percentage system saying so-and-so owns 60%, so-and-so owns 40%. That gets a little complicated when you start adding new people because the math is going to require dilution of one or the other. But you really have the choice with an LLC as to how you want to evidence ownership of it. LLCs are especially useful for sole proprietors because, in my personal opinion, which is backed by a great deal of legal analysis, there's no advantage to having a sole proprietorship over an LLC. And just an FYI, sole proprietorship, it is where you personally own all of the assets and going ons of the business as a going concern. It is simply you doing business as a trade name. That's what a sole proprietorship is. You report all of your profits and losses on your personal tax returns, your Form 1040, Schedule C and E. Sole proprietorships are nice and simple, but LLCs are just as nice and simple once you form them. With pass-through taxation for disregarded entity type LLC, it's the same thing. One owner LLCs, single member LLCs, report everything on their personal tax returns. They enjoy full limited liability protection that sole proprietors do not. Someone sues a sole proprietor, gets a judgment against them, they can go after that sole proprietor's house, cars, bank accounts, etc. But if you have an LLC, even if it only has one owner, that LLC, assuming it is owned and managed and administered properly, nothing shady going on there, no grounds to pierce the corporate veil, it will protect the owner's personal assets. So when asked the question, should I be a sole proprietor or should I have an LLC? My answer is LLC 10 out of 10 times. LLCs, unlike corporations, they don't have annual meeting or minutes or corporate reports to the states. You're not required to have any of that, though LLCs frequently elect to in their operating agreements. It's not a requirement. And so it can actually be really a lot simpler to administer an LLC than it is to administer a corporation, because some of those corporate niceties just don't exist. Now, as I talked about in the partnership section, LLCs can be especially useful for people who would otherwise form partnerships, because you can have that partnership tax treatment. You can have non-pro rata allocations or distributions of profits and losses, but you also have LLC liability protections for all of the owners. So you don't have to fuss with, do I need to make a limited partnership or a limited liability partnership or a limited liability limited partnership? Just make an LLC. And it is much easier to make an LLC than an LLP or an LLP. You file your articles of organization with the state. You make an operating agreement that all of the owners can agree on. And that is that. You move forward and run the business through the LLC. You can also make the LLC for a limited purpose or duration, such that the LLC automatically will wrap up and terminate or expire when some triggering event happens. So you can make an LLC for a limited duration or purpose, though admittedly it is easier to wrap up a partnership than an LLC, because with an LLC, you still have to file articles of dissolution with the state when you wrap it up. With a partnership, it's just done when it's done, which is why partnerships are still useful for B2B, business to business arrangements, as between two LLCs. I still use partnerships sometimes instead of, for example, an LLC jointly owned by two other LLCs. Now, LLCs, when you compare them to corporations, they can be useful alternatives. You can have S-Corp tax treatment for an LLC. The same restrictions apply. You can only have one class of units. You can only have up to 100 members of the LLC taxed as an S-Corp. None of the members can be non-resident aliens. All of that stuff still applies, but you get the LLC treatment, which means same limited liability, same S-Corp taxation. You don't have to deal with the corporate formalities of a real S-Corp, the annual meetings, the minutes, the et cetera, et cetera. You don't have to break things down into shareholders, directors, officers, as you do with a corporation. You can just have, LLC members and a managing member, for example, with an LLC taxed as an S-Corp, so they're easier to administer. And you can have anonymity. Anonymity in LLCs is something I'll talk about in just another few minutes here, but they're one of the biggest sellers for LLCs, at least in my practice. So you can have anonymity with an LLC taxed as an S-Corp. You can't have an anonymity typically with a real S-Corp. So that's one reason to use an LLC instead of an S-Corp. LLCs are rarely a good alternative to C corporations. You can have an LLC taxed as a C Corp. You can enjoy the C Corp tax treatment. You can have multiple classes of membership units, which are, again, the equivalent of shares. You don't have to do the annual meetings, meeting minutes, etc. Those corporate formalities don't exist with LLCs, though again, many LLCs opt to keep them anyway. And you can have the anonymity not available to C corporations. But, and there's two really big buts that makes me recommend real C corps in favor of LLCs most of the time. Investors still prefer real C corporations because, when it comes to C corps, they're governed by state level corporation acts, state level laws, a case law dealing with corporations, which are different from LLCs. It is much easier for a preferred shareholder to exercise their rights against a corporation than an LLC. It's easier for courts, especially if you're making, for example, a Delaware corporation, which is the most favored investment vehicle for institutional investors. Delaware has tons of statutes and case law that is very favorable to shareholders and spells out their rights with regard to their preferred shares. So investors prefer real C corporations to LLCs. Even if your LLC is going to have multiple classes of units, it's still easier to wrap your head around your rights as a C corp shareholder. It's also much easier to take a C corp public than it is an LLC. The hoops are different, but easier to jump through ultimately. It is also impossible to have LLC membership units count as what's called qualified small business stock, which is a tax advantaged scheme offered to C Corp shareholders if their C Corp value is less than somewhere between 3 and 5 million. I don't remember off the top of my head, but if the C Corp is worth under a certain amount and the C Corp shareholder holds their shares for at least, I think it's 5 years, you can get really preferential treatment on the sale of your C Corp interest. I mean, it's long-term capital gains, which is taxable at up to 20% typically, but you can write off up to half of the capital gains with qualified small business stock. So you get a lot of tax advantages when you're selling QSBS that you don't get if you're selling an LLC taxed as a C corporation. So things to keep in mind there. There's a lot of reasons to use a real C corp instead of an LLC. But we get to anonymity, which an LLC taxed as a C corp can have and a regular C corp cannot. An anonymous LLC is an LLC whose ownership info is not published in the Secretary of State database in the state in which the LLC is filed. That's where anonymity begins and ends for an LLC. Doesn't extend to tax entities. You're never going to be anonymous from the IRS or the state tax agency. That's tax evasion or tax fraud. You don't do that. Most of the secretaries of states themselves will know who owns the LLC, even if they don't publish that info. One big exception is New Mexico, which does not ask who owns the LLC. I mean, they ask, but you are under no obligation to tell them. Banks and lenders and whatnot still collect the ownership information because they're required to because of anti-money laundering laws, some bits of the Patriot Act, etc. So you're not going to be anonymous from your banks. And if you disclose who owns the LLC to a third party, like someone you're contracting with, you're not going to be anonymous from them. Not every state supports anonymous LLCs. There's only a handful of them: New Mexico, Wyoming, Delaware, Colorado, Virginia, a few others. But you can have anonymity in just about any state by virtue of using a parent-child setup. You make an anonymous LLC that you wholly own in a state like New Mexico, and then it forms a subsidiary LLC in a state like Texas, for example, which doesn't itself support anonymous LLCs. Texas asks, who owns this company you're forming here? You tell them it's owned by the parent company in New Mexico. That satisfies Texas. Texas publishes that in their Secretary of State database. But if anyone goes and looks that up, they see the New Mexico company owns the Texas company. You go to look up who owns the New Mexico company, and it's a dead end. That's how you get anonymity in just about any state, because LLCs, you can stack the ownership of them. You can stack ownerships of partnerships and corporations to an extent. There's limitations on S-Corps. You can't have a corporation or a partnership own an S-Corp, for example. So S-Corps are not terribly stackable. And the same goes for LLCs taxed as them. So that's a complication you have to deal with if you're looking for S-Corp taxation with a parent-child setup. There's ways of doing it, but you have to thread the needle. But otherwise, LLCs are stackable. So you can get anonymity, you can get stackability. LLCs are very modular, customizable entities. And everyone's needs are different. I mean, a big part of my practice, the majority of my practice now is consulting with people. I do tax and business consulting to advise them based on what their needs and priorities are, based on where they live and what they're doing and how they're going to grow, whether they want to sell, etc. Everyone ultimately comes out with a slightly different structure that works for them. So it's really important before you take that leap and form your LLC or corporation or whatever it is you're going to do. Think about what you need and where you're going with the venture. It really helps to talk to someone who knows about this stuff. And one of the best resources you can lean on is the Small Business Development Center. Reach out to your local SBDC liaison, schedule a counseling session. I mean, they have, as I understand it, free or low cost counseling, depending on your situation. I believe it's free. Great resources just at the tip of your fingers. I mean, I'd recommend reaching out and figuring out what your structure should be so that you're not in a situation where you've formed everything and then you get a few months or a few years in and realize, oh, I did this all wrong, because it is so much easier to plan ahead and make this work for you than it is to fix something you've already done. And I mean, I just say from extensive experience. So, that's certainly worth thinking about. Now let's get into some questions because we covered a lot. I know this is like drinking from a fire hose, but we covered all of the most common options. There's some things I left out, like business trusts, which are so uncommon unless you have a specific use for them, that I just didn't bother talking about them. Most people who ask for them, I end up getting into LLCs instead. But like I said, there's a million ways to customize this. So if you have any questions, type them out in the chat or in the Q&A. I'm going to look at the chat now and see what we've got in there.
We had one come in that I put into the chat for you, Ian, via email.
Okay.
It is the first question.
Okay.
Can you see that, or do I need to, would you like me to read that? Or
I can see it, so I'll go ahead and
Okay.
read it off for everyone. I got a question about separating two businesses. This person has an LLC for a landscape design and landscaping company, agro-environmental business, but they also organize a food festival. So there's two very different businesses. And they've used one LLC for any business related to the festival, but they want to launch a product line related to the festival. So they want to separate that out. They want to know if the DBA is sufficient to separate out what they do, or if they should use separate LLCs. And it's a great question, and I can answer it in a very general way. An LLC should be used for one business purpose, and there's a big reason for that. When I talked a few times about piercing the corporate veil, which is a process, let's say someone gets a judgment against your LLC or corporation. The owners are protected from personal liability, but let's say the LLC or corporation doesn't have enough assets to satisfy the judgment. Whoever has the judgment, the plaintiff in the lawsuit, will ask the court to let them pierce the corporate veil. And that's a fancy term that means I want to look past this company and go after its owners. And there are three main ways you can pierce the corporate veil for an LLC or a corporation. If there's commingling of funds, which means the owners use the company's funds for personal expenses or vice versa, that is one of the easiest and most common ways to pierce the corporate veil. If the entity is grossly undercapitalized, meaning the owners deliberately did not leave enough money in the company to pay its recurring expenses and reasonably anticipated claims, that's another way to pierce the corporate veil. The third, which is relevant to this question, is what's called the alter ego or instrumentality rule. If you are personally using your LLC for a number of different projects or ventures, and the only common denominator is you, that is what's called the alter ego approach. You are using the LLC as a mere extension of yourself. And so the court will say, okay, we're going to let this claimant disregard the LLC and go after you as the owner. One of the best and most proper ways to avoid that scenario is to have one LLC per business purpose. You are, let's say you are organizing a festival, have an LLC for that. Let's say you are creating and selling products, merchandise, t-shirts, water bottles, etc., whatever, and it's not a direct function of the festival. It's just something that you're separately doing for your own profit motive. Separate LLC for that. You've got a landscaping business, separate LLC for that. You can own as many LLCs as you want. You can even make a holding company, an umbrella company, if you want to have all of your different LLCs owned by a single LLC, whether for administrative or tax purposes, which again, tax implications, you can really get creative with these. You can do that too, but separate out the businesses into different LLCs.
We have gotten a lot of questions come in. Do you want to hop over to the Q&A first or finish the chat? And we have about 10 questions.
I will finish the chat. We may go slightly over time if that's okay.
Yep.
But let me finish the chat really quick.
Okay.
So someone asked if it's based, an LLC can be an S-Corp at the same time. The LLC can be taxed as an S-Corp, which we covered a little bit after this question was asked. You can have the LLC taxed as an S-Corp. And when I say pass-through entities, the net business income is taxed to the owners. It's taxed to the owners at their individual tax rates. And I'll give you just a quick example of this. You've got a 50-50 company with two owners who you look at their overall tax rates. Let's say the company's not bringing in a ton of money. It brings in 40 grand. That's $20,000 allocated to each of the 50-50 owners for tax purposes. But let's say one of these owners is in the 12% marginal bracket. They don't make a ton of money. They make a decent amount, but not a ton. And then let's say one of these owners is independently wealthy and their top marginal rate right now is 35%. One of the owners is paying taxes at their 12% rate on that 20 grand. The other owner is paying tax at 35% on their 20 grand. That's what I mean when I say it's taxable to the owners at their personal rates. It really depends on each owner's overall tax situation, looking at their income from all sources, not just the company. If you make your LLC as an S-Corp for tax purposes, do you have to have a CEO or president? No, you do not. Even if you have your LLC taxed as a corporation, the corporate formalities like directors and standard officers don't apply. You can have your members of an LLC and then any officer positions you choose to create. Most LLCs choose just to have a managing member as their officer. Let's see here. So there's that. What about DBA'S? All a DBA is doing business as. So that's a person or entity doing business as a trade name. So the underlying liability protections still apply or don't apply. If you have a sole proprietor doing business as, using a DBA, Bob's Plumbing, for example, it's still a sole proprietorship. There's still no liability protections. If you have an LLC, such and such holdings, LLC, DBA, Bob's Plumbing, that's different. You still have the LLC protections. Next question in chat, and then I'm going to move over to Q&A. So ask any further questions in the Q&A, please. If you make your own LLC, okay, I just answered the same question. Do you have to have CEO or president? No, you don't. No board of directors are needed for an LLC being taxed as an S-Corp. That is correct. You don't need directors for an LLC, whether it's taxed as an S-Corp or a C-Corp, because while it's taxed as a corporation, the management of it is still fundamentally an LLC, which it's a different style of management. No board of directors needed for an LLC. I've seen LLCs trying to create a board of directors on top of officers, and it gets weird. So if that's the way you're going, you might consider a corporation. So I'm going to jump over the Q&A now. I'm not going to look at the chat anymore, but on the Q&A side, I've got a question from a psychotherapist in private practice who wants to lower his taxes. He's heard that you should be making at least $50,000 a year for it to be worth it to have your LLC taxed as an S-Corp. Is this correct? Somewhat. The amount isn't necessarily correct, but some guiding lines for having your LLC taxed as an S-Corp versus your versus a disregarded entity or partnership. The big issue with S-Corp taxation for business owners, especially small business owners, is that the LLC or S-Corp has to pay the shareholders or members a reasonable salary, reasonable and regular, and reasonable is determined by the IRS. So if you have a brand new LLC that's just getting off the ground, it doesn't have any income coming in yet, I don't recommend making an immediate election for an S-Corp because you're not going to have the revenue to pay yourself a salary that the IRS requires you pay yourself with an S-Corp or an LLC taxed as one. When you have recurring revenue, 50,000 a year, is it worth it to make an S-Corp election? Probably. Depends on what your salary is going to be relative to what the net business income is, because if your reasonable salary is 50 grand and that's all the LLC is bringing in, then you're not going to have any net business income on top of the salary. You're not going to have any tax savings. But what you're going to have is a lot of complication, because with W-2 income, all of a sudden you have quarterly withholdings and payments to the IRS, quarterly tax returns for payroll taxes, an annual 1120S and a K-1. So especially if you're the only owner of the LLC and it's taxed as a disregarded entity, my advice is sit down with your accountant or CPA, figure out what the reasonable salary is for what you're doing, and figure out if it's going to be an actual tax savings. Because if it's not a tax savings, it's probably not worth doing, because then you're doing a lot of extra work for no financial benefit. Another question, as a property owner with the residence and rental units, love these. I've been told it'd be good to create separate LLCs for all. I understand the LLCs provide limited liability protections, but they also present complications. What are the tax implications if your primary residence is under an LLC and you realize a gain at the sale of the property? If one residence is under an LLC, does that disqualify the property for a head of household exemption? A lot of questions here. First, rental companies. I always recommend you keep each rental property in a separate LLC, so that if someone slips and falls at a property in one LLC and they sue the LLC and they get a judgment for more than the property's worth, they won't necessarily be able to go after the properties in other LLCs. It silos liability and prevents what I call liability contagion from one property spilling over into the others. Typically, with LLCs being pass-through entities, the rental income from those properties would be Schedule E income that would pass through to the owner, assuming you don't elect to have it taxed as a corporation, which I usually don't recommend for LLCs with rental properties. Just let it be a pass-through entity is the usual recommendation. It passes through to the owner and is reportable on your personal Form 1040 Schedule E for rental income. It can be pretty simple if you structure it right. Talk to someone to make sure it's structured right. Primary residences are a whole nother ball game, and I usually don't recommend you put them under an LLC, because you're not going to get LLC protections, because you're not using the LLC as a business. The LLC is just an extension of yourself to hold your property. If it's not a business, it's not doesn't have a business purpose, it's not really shielding anything. It doesn't protect the property from your personal creditors, because the LLC is just an asset in your hands like your property would be. And to the contrary, you get less protection from creditors, because your primary residence in your hands typically has what's called a homestead exemption, meaning a certain dollar amount of your house cannot be used to satisfy your creditors, your judgment creditors, etc. But your LLC does not have any homestead exemption. And the courts are very split on whether your personal property held in an LLC has a homestead exemption. There's a good chance it doesn't. And so I never recommend putting your personal residence in an LLC. There's just no point to it. As far as I can tell, I mean, I evaluate each situation on a case-by-case basis, but I have yet to hear a compelling reason to put your personal residence in an LLC, because you don't get real LLC protections and it weakens your creditor protections. Next question, do you recommend startups file the LLC themselves or with the help of an attorney? I will say, as an attorney, it might be self-interested to say this, but it never hurts to have help when you are doing something like this, because especially if anonymity is a concern, there's 100 ways to do it wrong, in which case you won't have anonymity. if you do it wrong, maybe you don't get the LLC protections you need. So talk to an attorney. It's a good thing to do, or at least use a service that forms these LLCs regularly and knows what it is they're doing. But an attorney, consulting with a business attorney can help you map out the structure that you need to maximize your tax benefits, your anonymity, if that's what you're looking for. Make sure you're complying with the state laws of the states you're operating in. That's a big one. I mean, I deal with multi-state structures all day, every day, because not everyone provides services just within their own state lines anymore. We're in an increasingly global world, and you want to make sure that you're covering yourself. So talking to an attorney is never a bad thing here. If you live and work from 2 states, do you need to file LLCs in both states? I'll give you the very short answer to this. Each state has a requirement that if you're engaged in business in state lines, you need to register your business there. So if you have an LLC that is providing cross-border services, let's say between New Mexico and Texas, you'd form the LLC in one state and then register it secondarily in the other as a foreign entity. So you register your LLC. It can be one LLC, but you register it in all the states in which you're required to register it, meaning if you're engaged in business in state lines, you probably need to register it there. If you have 2 branches of business, such as a practice and an author branch, should they go under the same LLC? I'm not sure what an author branch is exactly, but and I'll answer the question more generally. If you have 2 branches of business, it depends on what those branches are. Like if they're separate locations of the same business, you've got, I'll use a common example, a dental practice that has multiple sub practices, like multiple locations that's offering services via its employees. You can have it under a single LLC or a professional corporation, or you could form multiple for each location with common ownership, maybe using an umbrella company, but trying to isolate the liabilities of each location to that LLC. Same thing, you can structure this in such a way that you're preventing liability contagion and maximizing your LLC protections. Yeah, I mean, it's depending on your specific needs and situation, I would advise you one way or the other. I just don't know that I can answer it more specifically than that, I'm afraid. How much does it cost to file an LLC in New Mexico? It really depends on your specific needs, because I'll give you some examples. I mean, I can file an LLC in New Mexico for $50, but it doesn't come with any of the things that you might need: an EIN, an operating agreement. Hiring a lawyer or other professional service company to do it, you might be looking at $200, $250, $300, depending on your specific needs. They're not horribly expensive. They're expensive in some states. Texas, New York, California, they can be horrifically expensive, but in New Mexico, they're pretty cheap. I already covered DBA'S. DBA'S, they're really just a person or a business entity doing business as a specific trade name. So, if you personally as a sole proprietor are using a DBA, like, Joe Smith, DBA, Joe's Plumbing, the DBA doesn't offer you any additional protections or anything. It's not a legally distinct entity. So if someone's suing, if you're getting sued, you're getting sued as Joe Smith. But if you are Joe Smith and you have Joe Smith LLC, DBA, Joe's Plumbing, assuming you're running the LLC properly and disclosing that you're using an LLC, which is one of the things you have to do in contracts and whatnot, it's the LLC that's getting sued. So the DBA is just an extension of whoever is doing business. And that is all the questions I can necessarily answer here. But if you have anything else, please let me know. And I'm happy to go back and forth via email at a later date as needed.
Yes, and also visit nmsbdc.org for the no-cost business counseling. We'll be glad to get you the resources that you need. So with all that information, we will be seeing Ian Alden again, but we are going to dismiss you for today. Thank you.
Thank you all.